It has been released today, a short while ago. As you're all aware, in February this year, the Ministry of Statistics and Program Implementation introduced the new series of annual and quarterly national accounts estimates with the base year 2022-23, which replaces the previous series with the base year of 2011-12. Accordingly, today the provisional estimates of annual gross domestic product for FY 2025-26 and fourth quarter GDP estimates for FY 2025-26 have been released. We have with us Secretary MOSPI, Dr. Subhash Garg, and the Chief Economic Advisor to Government of India, Shri Anant Nageswaran, to give us more details about the estimates released today. I welcome you, sirs, to today's briefing. I also welcome my senior colleagues from MOSPI. In the sequence of events, first we will have a data-related presentation by ADG MOSPI, Shri Siddharth Kundu. This will be followed by remarks of MOSPI Secretary. Then there will be a detailed briefing and analysis sector-wise, as always before, by the CEA. In the end, we will have the interaction, the question and answer session. So first I will invite the ADG MOSPI, Shri Siddharth Kundu, to come and make his presentation.
Respected Secretary, Sir, Saurabh Garg, Sri Dr. V. Anant Nageswaran, CEA, DG CS, Sri N.K. Shantoshi, Ms. Bhashin, DG PIB, my friends from MOSPI, press and media people. Now this is the presentation after the base year revision. First time we are presenting on quarter 4 estimates and provisional estimate for 25-26. Next slide, please. In this presentation, it is mainly content is broad methodology, then data sources, then we'll discuss about the quarterly estimates of this quarter 4, and then overall provisional estimate of 25-26. Now before starting, let's first tell you the brief methodology for quarterly estimates. Next slide. What is done actually here in compilation of quarterly national account, we use that benchmark indicator method. In benchmark, we take the figures from the previous year's estimate and then we quarterize it first, and then after quarterizing using certain indicator like some high frequency indicator related to that particular sector, we use to estimate that particular quarter's estimate. The indicators we are getting from various ministries, departments, states, private agencies while compiling these estimates. These indicators are very big in numbers, say about 180 to 200 indicators are used. Mainly for agriculture and allied, we use the production estimate data from Minister of Agriculture and Family Welfare, then Minister of Fisheries, Animal Husbandry data. Then for mining, electricity, etc., we use IIP coal, petroleum, natural gas, metallic, non-metallic minerals of IIP electricity, gas, consumption from petroleum and natural gas. For manufacturing, trade, hotel, real estate, professional service, and other services like health and education, etc., we use the listed companies' financial returns data as well as GST for indicator. Then for construction, we use the cement production index from DPIIT, steel consumption from Joint Plan Committee, then IIPs. Then for uh, balance of payments data from RBI, then VAN data, then export import from DGCIS, food grain bulletin for PFC, GFC, export, import, and also valuables. Then PFN's data for public administration, defense, and net taxes. Then also we used the loan deposit interest information of banks, NBFCs from RBI, information of life and non-life insurance, etc. From IADII for financial services. Then rail, passenger, goods, air traffic, cargo handled at ports and from Ministry of Ports, shipping, vehicle sales from SIAM, telecom data, etc. for transport and communication sectors. As well as we are coming out with the constant price estimate. For constant price estimate, we use the granular WPI, CPI, and unit value index data. So using these data, we generate the quarterly estimate, and provisional estimate for whole year is essentially sum total of this quarter-wise estimate. Next slide, please. Now, what we have found in the real GDP growth in quarter 4 estimate of 25-26, it is essentially, you can see in the picture graphs that it is a reasonably good growth rate has been found from the quarter 1 to quarter 4, and quarter 2 shown the highest 8.3%, whereas for this quarter 4 figure found to be 7.8%. It is essentially driven by the tertiary sector, which will come later, and all the quarters of FY 25-26 performed well. Next slide. Now, if we see the activity-wise, sector-wise growth in quarter 4, you will see that it is mainly driven by tertiary sector, that is trade, hotel, transport, communication, financial, real estate, which had shown more than 10% growth, as well as manufacturing sector was also growing reasonably good at 7.3% in quarter 4, and agriculture and allied sector, which was also showing good growth compared to its past quarter 1, 2, 3, that it is about 3.6%, earlier it was 2.6%. Next slide, yes. Now, if we go to the expenditure component, then we will see that major share of expenditure is GFCF and PFC, which is about 85 to 90% share, and GFCF recorded about 10.8% growth, and PFC is 7.1% growth. And export and import was showing 3.7 and 1.9% in quarter 4 respectively in the 25-26. However, this was little bit lower compared to its earlier quarters. Now we turn to the whole financial year. Now, whole financial year, if we compare to SAE, it was 7.6% earlier, which was released on 27 February this year. Now it is, the provisional estimate is coming to 7.7% growth. And the 7.7% growth is consistent, and it is more than 7% is in the last several years. We are seeing that in 23-24 it was 7.2, then 7.1, then 7.6 in the for the same year in second advance estimate. Now, if we see the sector wise, next slide please. The sector wise, then sector wise it is showing that manufacturing sector is showing a reasonably good growth rate, that 10.7%, and double digit growth was found in the first 3 quarters. Tertiary sector, There is services sector shown a consistent growth of more than 9% in all the quarters, driven by mainly trade, financial services, and professional services. Along with it, growth in agriculture and allied sector also recorded growth rate of 3.0%. Earlier it was 2.7%, and now updated production estimates of crop and fish information have been received, and accordingly the figure is 3.0% for the agriculture and allied sector. Now, if we turn to the expenditure component of this financial year 25-26, that contribution for PFC and GFC is about 89% in overall GDP. PFC is recorded 7.7% compared to 5.8% which was in the previous year. Now, GFCF is the main instrument for growth. It is registered 8.2% growth, higher than 6.4% which was in the previous year. Now, with these more or less estimates are over, now along with it I would like to say that IIP is revised very recently and PPI is also coming. Then we will use this information for the 22-23, 23-24 and 24-25 till in the August estimate, updated estimates will be made available to you, and along with it we will also provide the detailed methodology stating that quote unquote sources and methods we say, that will also be made available in August 26. Along with national account statistics of 26 will also come in August. Then the back series which we are working with is planned to be made available by the end of this current calendar year. So that's all. Thank you.
Friends, there's a slight change. So first we'll have the detailed presentation by the CEA, followed by the remarks of Secretary Mosby, Dr. Saurabh Garg. Sir, I invite you for your briefing.
Good afternoon, everybody. So we had the summary results of the fourth quarter, 25-26, and the full year data by my colleague in Mosby. We will now walk you through some of the finer details and also give a flavor of the opportunities and the challenges we face with respect to 26-27. Next slide. So if you look at the growth momentum, this slide was already shared by my Mosby colleague as well, and the quarterly breakdown, so I don't need to belabor this slide. We saw the post-COVID growth rates of more than 7% in the old series, and we are able to see that in the new series as well. And with the promise of incorporation of PPI and IIP data in August, I'm sure that some of these numbers will look even more well-grounded in in terms of the GDP outcomes. If you look at the granular data, again, was presented by my colleague, but you can see that the gratifying thing is not only the pickup in services sector growth rate, but also the near double digit in 1 year, but more than double digit in the other 2 years in manufacturing share growth rate as well. And if you look at the expenditure components, you can see that the private final consumption expenditure found its footing in FY26, and the more gratifying thing, as in the case of manufacturing, in the bottom left chart, you can see the gross fixed capital formation rate being 8.2%, which is a good pickup. And that continued in the quarterly numbers as well that we saw. So overall, I think it's a balanced picture with respect to the different components of the economy contributing to growth from the GVA perspective and also from the expenditure perspective. Now, obviously, this is the solid backdrop with which the Indian economy began to confront the February 28th West Asia conflict. So as we entered, and in fact, if you recall, on February 27th, Secretary Garg and I were there in the press conference related to the new GDP series. And at that time, I had mentioned that the forecast, or the estimate rather, for FY27, which in the economic survey we had placed at between 6.8 and 7.2, I was revising it to between 7 and 7.4, but then the following day, the conflict opened up. So now obviously we are looking at the various challenges, and the central bank this morning told us that they are revising their estimate from 6.9% down to 6.6 for the real GDP growth in FY27, but with the downside risk attached to it. And they also said that 5.1% will be the inflation rate from CPI headline basis for 26-27, and again attaching an upside risk to that number. That seems to be a fair assessment of the situation by the central bank, and we have no reason to second guess them at this point, because there are both possibilities on the upside and on the downside with respect to the numbers that they had presented us this morning. So if you look at the 4 different challenges we are facing, one is of course the energy shock. The crude oil prices are still, in relation to what one could have anticipated, given the amount of supply disruptions created by the conflict, the Brent crude is still trading below $100 in the financial futures contracts. But we also hear of a lot of physical market prices being much higher. At the same time, we also hear stories about a complete reduction in the imports of crude oil by China and a drawdown of inventory by the United States, etc., all of which are contributing to oil prices staying below the 3-figure mark. But will it continue to stay below the 3-figure mark and continue to decline as the financial futures contracts suggest? Or will supply disruptions come into prominence in the second half of the Indian financial year, leading to much higher prices? And that will determine the course of both growth and inflation outcomes, not only in India but elsewhere in the world, both for calendar year 2026 and for FY27 as far as India is concerned. And what our government has been able to do is to ensure adequate availability of all necessary petroleum and petrochemical ingredients for the real sector. It is the prices that are globally determined that remain the uncertain factor. And the tanker traffic is still relatively scarce, almost close to non-existent. And the fact that 3 months into the conflict, there is no clear apparent pathway to a resolution, after which the removal of the mines in the strait will take place, and after which it will be open for tanker traffic, and then the supply disruptions in the petroleum and petrochemical complexes in the Gulf area will have to be restored before pre-February 28 normalcy, both in terms of production, export, and tanker traffic can be restored. So you can imagine the uncertainties embedded in all these stages that need to happen for the global economy and the Indian economy to be restored to the pre-February 28th kind of arrangement in terms of flows of energy across the world. So in fact, one of the things we closely follow is the US Department of Energy's Energy Information Administration, EIA, puts out a short-term energy outlook. And it is a monthly publication. In fact, the next one will be due next week. Now, what is interesting, or rather concerning, depending on one's perspective, the supply disruption that they estimated for in the month of April, especially for the 3rd quarter and the 4th quarter. In April, the estimate was that 2.2 million barrels per day of oil supply would remain disrupted. In the May edition of the short-term energy outlook, they increased that number to 6.4 million barrels per day. So 3x increase. For the 4th quarter, they had estimated a near normalization of the oil supplies in the world. But now they have estimated that the supply disruption will still be of the order of magnitude of 1.7 million barrels per day, which is a 10x increase. So given this kind of massive increase or upward revision to supply disruption numbers, we have to be mindful of the fact that the oil price remains still a big question mark as we go into the second half of the calendar year and 3 quarters of the financial year as far as India is concerned. But nonetheless, at the same time, as is the case with respect to global trade, there are positive surprises that global trade has remained resilient. Indian exports have remained resilient in the month of April. That is what the trade statistics tells us, because the core exports, if you take away the petroleum products and gems and jewelry exports, the export growth rate of merchandise was in double digits. And so was services sector exports. So, and early indications for May also suggest that exports performance remains strong, which is something not we would have expected given the disruption to global trade flows because of the strait. So there are a lot of things that are happening, moving parts, which we don't fully comprehend, both positive and negative. Therefore, it will be premature to come to conclusions about the direction that growth and inflation outcomes would take. And that is why we would refrain from giving point estimates at this stage from the Ministry of Finance side, but refer to the RBI's numbers released this morning as the base and work with their assumptions and downside and upside risks as stated by them. So if you look at the high frequency data, some of which are available all the way through to May, some of which are available only up to April, and we are providing last year's numbers for comparison. If you look at it, barring fuel consumption in April, which was down, all other numbers are not even are either light green or strongly green, which indicates a fairly strong momentum of economic activity, which has continued from the fourth quarter, as seen by in the presentation by my colleague in the Ministry of Statistics, continuing into the financial year FY27 as well. And same thing applies to domestic demand, in particular, in spite of the prospect for petroleum prices increases, which happened in May. Urban auto sales and rural auto sales were growing in double digits into April. The headline CPI figures, of course, last year we all know very well that there was a beneficial base effect coming from the higher food prices of FY25, which gave a good downward momentum to FY26 prices, aided by a very good monsoon. And therefore, the lower food prices also contributed to an extremely tame outcome in the headline CPI inflation rate as well. Naturally, those base effects were going to be working differently in the current financial year. At the same time, now we have the prospect of a monsoon whose likely performance has been somewhat downgraded in the May edition of the IMO compared to the April outlook they gave. And therefore, naturally, there is an upside risk to the the overall inflation and the food price inflation this year, which the central bank has acknowledged in revising its number from 4.6 to 5.1% for this year, with an upward risk attached to it. So I think that's a fair estimate. And the rising WPI inflation is also presaging further upward momentum to CPI. But the good news is that it will mean that the nominal GDP growth for FY27 will be significantly higher than the number which the budget estimates used of 10.1% for the current financial year. Moving on, in terms of apart from the consumption-oriented sectors, if you look at the supply side of the economy, the manufacturing sector growth, which was very high in FY26, if you look at the steel, cement, consumption and production respectively, capital goods imports and IIP capital goods, and if you look at the IIP infra goods, all these numbers are all also in light green to strong green with data available. You might think that there's only 1 month of data for the new financial year, but remember, it is 2 months of data since the conflict broke out. So in that sense, it is quite reassuring to see the resilience in these high frequency indicators 2 months after the conflict broke out. So that is something that you need to keep in mind, that there could be the lagged effects of the various structural reforms, not only of the last decade, but also post-COVID, and the continued investment in the capital expenditure and the supply side infrastructure made by the government over the last 10 to 12 years, continued post-COVID, may be contributing to certain resilience, which is what we are beginning to see in the data. And that is something we need to keep in mind while we assess both the upside and the downside risks to GDP numbers in FY27. And also, as I mentioned, while prices of energy products are determined in global markets, what we can do and what we have been doing is to ensure adequate supply, which is what the government has been doing over the last 3 months since the conflict broke out. On energy management, while there have been a lot of short-term measures, there has also been a focus on the medium to long term, which is to ensure augmentation of strategic buffer through the agreement with the UAE government, and then ensuring that crude imports are diversified through multiple sources. And apart from the additional excise duty reductions, we also been paying attention to energy diversification, which this crisis has imparted a further momentum to. Coal and lignite gasification schemes notified, and 37,500 crores allotted to it. Imported coal-based plants being fully operationalized, etc. So basically, both supply-side measures and demand-side measures, while keeping the household disposable income in mind, the pass-through has been relatively mild in comparison to the price increase we have seen so far. So therefore, the burden sharing between the government and the OMCs and the households has been very much strongly kept in mind in ensuring that the pass-throughs are relatively mild so far compared to the kind of underlying price increases in the crude oil prices. And on the trade and logistics side, which is probably one of the reasons why we are seeing export resilience, is the various measures taken to ensure logistics shipping risk and restoration of the RODTEP rates, and then the MSME free rebate for MSME exporters, and also customs duty hike on gold, silver, and platinum to ensure that non-essential imports are discouraged in this current environment. At the same time, also process improvements made to ensure that exporters are able to minimize the frictions that they encounter in normal circumstances. And in order to facilitate their export growth, these measures have been taken. Further, with respect to ensuring availability of fertilizer for the current Kharif crop season, gas allocation to fertilizer plants, adequate availability, because the opening stock of fertilizers has been more than 50% compared to the usual 33% of the fertilizer usage during the Kharif season. And imports have also been secured from alternative sources. Large global procurements have been undertaken, and there is also attempts to ensure that fertilizer usage is judicious, keeping in mind the supply constraints that we are facing. And sugar exports have been banned just to ensure that enough sugar is available, enough sugarcane is available for ethanol and biofuel production in general. With respect to industry and services sectors, customs duty waiver on 40 petrochemical products, 29 textile and man-made fiber inputs, QCOs on morpholine suspended, and there is an emergency credit guarantee scheme as a proactive measure to forestall and preempt distress in the MSME sector. And separately for the airline sector, which has been facing its own challenges since last year, and since fuel costs constitute a significant portion of the operating cost, there are separate measures also identified for the airline sector. So what we are seeing is sort of a proactive response, multi-sectoral, macroeconomic, and ensuring supply side in terms of availability of raw materials and ingredients. So overall, to conclude my presentation, the evolving West Asia crisis represents both a significant supply shock and a potential demand shock, but the demand shock could be both positive or negative. We have to wait and see, because we are seeing extraordinary resilience in the high frequency data, which we should not dismiss out of hand. And as I said, most high frequency indicators suggest that domestic demand and overall economic activity have remained relatively resilient, but there could be emerging signs of stress. We have to wait and see how the oil prices evolve, and there is also a monsoon related uncertainty, which we have to keep in mind, not only in terms of inflation, and also in terms of what it means for disposable income and private final consumption expenditure going forward. So there are multiple things to look for, both on the upside and on the downside. The overall trade deficit widened in FY26, and a similar trend with potentially wider deficits is possible in FY27. Policy measures undertaken will help, and I went through them in detail, to contain supply side disruptions, creating safety nets, and maintaining macroeconomic stability for future growth. So even if the growth were to slip below 7%, as the RBI forecast suggests, these macro stability measures and supply assurances will bring us back to the 7% plus growth track in FY28, or as soon as external conditions permit. Improved policy certainty resulting from trade agreements. Again, I think in the course of the current financial year, we might see the trade agreement with the UK becoming operational, and could be the case with the EU as well. And last couple of days, we have been seeing encouraging pronouncements on the possibility of a provisional or a durable trade agreement with the United States. And the agreement signed with EFTA on investment inflows has become operational since the end of last calendar year. So all these things will also continue to boost export prospects in an otherwise challenging global trade environment as well. And then the continued pursuit of structural reforms, as in the case of labor codes, deregulation in states, etc., in this period of uncertainty will strengthen the economic foundations and position the country to restore sustained high growth after the current uncertainties fade away. So these are my prepared remarks. Thank you very much, and Secretary Garg will address you, and then we will take questions. Thank you very much.
I welcome MOSPI Secretary Dr. Saurav Garg, and I request him to give an overview of today's GDP estimates, which have been released by MOSPI.
Thank you. I really don't have much to say, and we'll switch straight away to the questions and answers, but just wanted to highlight 2 or 3 things which are significant, keeping in view the Q4 estimates that have been released and the provisional estimate for 25-26. First of all, we need to especially note that the gross fixed capital formation, which is in fact the investment, that has shown a extremely robust growth of 8.2% in FY 25-26, and which signifies that the investments in the economy have been significant. 24-25 it was 6.4, and 25-26 it is 8.2%. And if we look at the capex expenditure, both capex expenditure and the grant in aid, the increase has been 14% compared in 25-26, which again signifies high capital expenditure focus by the government, and overall also including along with the private sector. The second point I just want to highlight is the fact that there has been a significantly high consumption of finished steel consumption as well as cement. So both finished steel and cement. Finished steel has shown 8% growth in 25-26. In Q4, in fact, it is 10.4%. And cement has been 8.7% in 25-26 and 8.2% in Q4. Both these signify, number one, that the construction activity has been extremely buoyant, as well as investments in the infrastructure broadly have been extremely significant. The third thing which I just want to highlight is the fact that private financial consumption expenditure has been extremely robust. It's been a big driver. For example, passenger transport vehicle registration has been double digit both in Q4 as well as in 25-26 as a whole. So which signifies that discretionary consumer spending and household confidence has been significantly resilient which is what the CEA was mentioning. One other factor which I just want to mention, that despite the geopolitical situation, the export growth has been the highest of 19.4% in the IT and telecom services, which is also a very significant and a very positive feature. And lastly, if I can just say that the resilience of the economy is also highlighted by the strong growth that has been seen in the agriculture sector. including in oilseeds and sugarcane. So other crops have also done extremely well, and agriculture in general has shown very good resilience. I just wanted to highlight some of these features of both quarter four and last year's provisional estimates. Thank you.
Thank you, sir, for your insights. And now we'll start with the question and answer session. We will be answering all the questions, so please raise your hands one by one, and then we'll take your question. Introduce yourself before asking the question. Yes, Shrimi, would you like to ask?
Hi, this is Shrimi Chaudhary from NDTV Profit. As you mentioned in your economic outlook that the trade deficit widened in FY26 and a similar trend is likely in FY27, potentially adding pressure on the current account balance. Just wanted to understand from you and your views on that. We have seen government has just given tax relief to FPIs. How that going to help in current account balance to improve CAD?
Sapna?
Hi, Sapna here from CNBC TV 18. A broader one. Sir, you mentioned that Finance Ministry as of now may not be, willing to conclude any kind of estimates on inflation and growth front. And the RBI estimates are out since morning. A downward revision in estimated GDP growth by FY27 and upward revision in CPI. So do we understand that, because, earlier on you had suggested that maybe after 2 months we'll be re-looking the numbers internally in the government. So will that exercise still happen, unfold, or not really happen as of now? And should we just go with the 6.6% RBI forecast as of now for FY27 GDP as well as 5.1 for inflation? Thank you, sir.
Shishati?
Yeah, good evening, sir. Shishir from Hindu Business Line. Sir, I have two questions. One, you talked about that nominal GDP will be much higher than 10.1% as projected in budget. Does this mean that the fiscal deficit will be contained what we see the budget estimate, but the actual fiscal deficit in value term will be much higher because of the higher expenditure on various provisions? And the second thing is when we are talking about GFCF of 8.2%, and there is also a lot of complaint that the private sector investment is not coming. Does this mean that 8.2% mainly coming from public sector? Thank you very much, sir.
So to first address Shirmi's question, the measures announced this morning will definitely help to finance the current account deficit. That was the idea. Naturally, if you look at the even 22-23 data, when oil prices spiked in the wake of the Russia-Ukraine conflict, and it lasted about 5 to 6 months in the financial year 22-23, the current account deficit widened to 2% of GDP in that year. So this year we have to wait and see. There are large unknowns. There is no point in trying to speculate on what the eventual current account deficit numbers will settle at this point. It could be, we are seeing export resilience. At the same time, we also wait to see whether the crude oil prices will follow the trend as implied by financial futures, or will something else happen? We don't know yet. But clearly, the measures announced today, both by the central bank and by the Ministry of Finance, are meant to help facilitate smoother financing of the current account deficit. For Sapna's question, I think I was quite clear in what I said. We'll go with RBI's estimates for growth and inflation with the risks that they attach to it, nothing more to add there. And as far as your point is concerned, Shishir, while we say that the private sector capital formation could be higher, it doesn't mean that the private sector capital formation is not growing. So whether that number will continue in 26-27 and will private sector investments accelerate compared to the previous years is something that we have to wait and see. I don't want to speculate on what the breakup will be as to who will contribute more to the gross fixed capital formation. It doesn't serve much purpose.
Deepshika, would you like to ask the question?
This is Deepshika from Economic Times. Sir, in your presentation, my questions to the Chief Economic Advisor. In your presentation, you mentioned that the pass-through of the higher prices has been contained so far. I mean, it has been tempered. And you also said, you spoke about the demand impact, potential demand impact. So in terms of the pass-through, we've seen some increases in fuel prices. What kind of impact could it have on demand going forward, that and when pass-through increases, going forward prices are increased further? And also you spoke about that the government should continue with structural reforms. What are these reforms that you're alluding to?
Surbhi?
Hello, sir. This is Surbhi from Business Today. So the RBI estimate has put growth at 6.6% with Q1 at 6.6 and Q2 at 6.3. So you said that domestic demand has been resilient, but are there any pockets of slower economic activity that have been observed till now? Because how is this growth slowing down is what I wanted to understand. So secondly, government final consumption expenditure has been on the lower side, sir. So could you please explain on that as well? Thank you.
Prakash?
Sir, Prakash Pedashi from ET Now. Fertilizer subsidy is likely to cross 3 lakhs crore in FY27. Also, OMC may need to be compensated going forward. Do you think that these factors may put pressure on government's fiscal glide path?
So, Deepshika's question on the pass-through and the impact on demand. See, impact on demand is not coming only from the pass-through effect. It can also be positively impacted by underlying growth in economic activity, which the high-frequency indicators are saying they're holding up very well. Therefore, to calculate the net effect on the overall private consumption is a bit difficult to come up with a precise quantitative estimate at this point. I think, Shishir, I didn't answer one of your questions, which also relates to, it will be difficult for me to give you some very precise answers at this stage with only 1 month having passed for the fiscal deficit estimate, what it will do to the fiscal deficit ratio or the absolute numbers. These are moving parts. I think when there are large number of unknowns, it is somewhat futile to speculate on various scenarios. It will only be grist to the mill, and it will not add to the information content. It will add to the noise content. So I'm not going to speculate on them in public, and that's a response to your question as well. With respect to the government consumption, final consumption expenditure, these are not something which we have ever come up with the predictions on them. They are not seasonally adjusted. We have 1 month of data. I can't give you an estimation of what is going on, because these are both operating expenditure as well as capital expenditure. We have 1 month of data for the current financial year, so there's no point in speculating on them. Sorry? Growth?
Is economic activity slowing down, and is it being observed in any sectors?
No, we presented to you all the numbers that we have. And those numbers are showing resilience. And what the RBI is shown is that, yes, because of the higher energy costs, which obviously underlie all economic activity, and the forecast of a weaker monsoon, which will have implications for agricultural output and also for food price inflation, which could obviously have an implication for disposable income of people. Naturally, there is an anticipation that economic activity will be slower. So it is difficult to be any more precise than this. On the structural reforms, what we put out in the economic survey is what we refer to it in terms of lowering the cost of doing business.
Meghna?
Hi, Meghna Mittal from Money Control. In a year of such geopolitical uncertainty where the government will need some extra expenditures for uncertainties, do you think the high capex that was announced in the budget should be kept is the way forward for the current financial year?
I have no comments to offer at this stage on that question.
Sir, I'm Kaushal Verma from ANI. Sir, my question is that you just said that we are having 7%, sub 7% GDP outlook for this FY27, and maybe in FY28 we are saying above 7%. So do you think the ripple effects of this global turmoil in the West Asia will die down in a year, or what could be the positive drivers? You mentioned some, but do you think this will die down?
Tarun?
सर तरुण शर्मा फ्रॉम जी बिजनेस सर आपने अपनी स्पीच में भी कहा और कमेंट में भी कहा कि फूड इन्फ्लेशन और मॉनसून की वजह से हाउस होल्ड सेविंग्स जो है उस पर इम्पैक्ट आएगा। तो सर ज़्यादातर हम देखते हैं कि स्मॉल सेविंग्स जो हैं वो लास्ट क्वार्टर में आती है, तो आपको लगता है कि गवर्नमेंट के लिए वहाँ पे मनी रेज करना थोड़ा मुश्किल हो जाएगा और रेट्स में कुछ बढ़ाने पड़े?
So, as far as, when there are so much of uncertainty, asking me to predict how things will shape up in FY28, it's an expectation and a hope that I expressed that at some point in the course of the current financial year, the pre-February 28, 2026 conditions will be restored. Going into financial year 28, we could look ahead to a period of 7 or 7+% growth. Now, if these conditions continue instead of dissolving, then obviously we will revisit. But there's no point, as I just now told Shishir, there is no point in speculating too much when there are so many unknowns. Okay? Now, whether the household savings will be lower and therefore will it have difficulty in financing the government budget, government spending program, etc. Look, the household savings as per RBI data in up to FY25, the net financial flows have improved from 5.2% in FY23 to 7% of GDP. And if anything, we have been underestimating the total financial wealth of the households because of the, in the old base year 2011-12 series, which MOSPI has now corrected, the households' investment in the capital markets over the last 7 to 8 years have picked up consistently, and some of the standard assumptions that were made in the original 2011-12 methodology have now been updated. So that kind of tells us that we probably were not fully taking into consideration the ample financial resources available in the household sector. And therefore, and we have also now made it more easier for some of the foreign investors to finance the government borrowing by opening up the FAR in 15, 30, 40-year segments, etc., and removing withholding tax and capital gains. And at this stage, it is premature to, again, discuss, as I mentioned in the case of other questions, that government will have a difficulty in financing its borrowing program because there is no expectation at this stage that the borrowing program will need to be increased at this point.
Any Hanji, please go.
Thank you, sir. Manoj Kumar from Reuters News Agency. Sir, from this better than expected Q4 growth numbers, so it seems that despite these numbers that which are only reflecting only 1 year's pain, 1 month's pain of March from the West Asia crisis, the manufacturing growth and the private consumption seems to be slowing down, perhaps reflecting pressure on the consumers coming on the jobs or on the inflation as well. So I have two questions. So one, many people suggesting that on the domestic front, so what additional measures needs to be taken to give relief to the consumers? Secondly, on the global front, it seems that that IMF also talking about our economy, despite these numbers, is slipping from 5th to 6th globally, in the growth. And many people suggesting that now, despite today's measures, so that may not be sufficient to finance our widening current account deficit, and from fragile 5 we are not now the most vulnerable economy in the world. Thank you.
Anybody else? Any more question? I think so. This is the last.
So, okay, so there were 3 questions, I think. If I miss out on anything, let me know. What additional measures will be needed? At this stage, we have to take it one step at a time. We have to, there is a global supply shock, and there is higher prices being felt across the energy spectrum and also in the petrochemical spectrum. So to be able to minimize and smoothen the burden sharing between the different segments of the economy is the government's priority. Now, and the government has come up with an emergency credit relief guarantee scheme for MSMEs, and only last year the income tax slabs were widened and the income tax rates reduced, GST rates lowered, and GST slabs rationalized. So some of these measures have been put in place, and they will also be providing a certain level of comfort and cushion to households. So, so ultimately, depending on the length and the severity of the shock, the government will be considering and contemplating if any additional measures are needed. There is no point in speculating on them at this stage. Now, your question whether these measures put in place today will be adequate or inadequate, those who said they may not be adequate, probably you should ask them for more clarifications than from me. And also, in terms of the GDP ranking, these are functions of the exchange rate. As and when the exchange rate appreciates, some of these rankings will be automatically restored, because our nominal GDP growth even this year will be in double digits, as I mentioned, even better than the 10.1% that we budgeted, which we used in the budget calculations. The slippage in FY 26 was partly due to the reduction in the nominal GDP value from 357.5 or 357.6 lakh crores we had under the old series, came down to 345, which now I think somewhere around 346 something in the current situation, and also the exchange rate slippage. But as interest rates in the developed countries take a different path and real rates become negative there, etc., and as and when the capital flows return, once the current bubble-like mindset related to AI stocks, etc., fade away, then these tendencies will reverse in the same speed with which they reversed in the case of India's GDP ranking, going from 5th to 6th. So I don't think, ultimately, as I have said in my last several years in this role, our job is to do all the right things. Then the GDP rankings will take care of themselves. You already asked 3 questions.
We are slipping that.
So the per capita GDP slippage and the question you asked about the ranking, both of which are due to the exchange rate effect. In domestic currency terms, our per capita income is growing at a very healthy clip. These comparisons are based on the current exchange rates, and they can as easily go back in our favor in the short period. So I don't think we should be laying great store by what is happening in the currency translation effect. Ultimately, what matters is whether the real purchasing power of the Indian households is growing, and on the aggregate basis, based on nominal and real GDP growth and the population growth, the per capita incomes are growing at a healthy clip. That's what matters.
If I can just add that we are the fastest growing global economy now, and we have been so for the past 3 years. So in terms of growth, as has already been discussed, we are still very robust in the past 3 years consistently.
So friends, with this we come to the close of the media briefing. I thank all of you for joining in today's session, and I also thank the dignitaries on the dais for their insightful interpretations to today's GDP data. Thank you all.